Security joins us now. Nilesh, good morning. Thank you for joining us. Has the storm come and gone? Dow is less than 3% away from an all-time high. Who would have thought first the selling would be acute and then the comeback after that would be surprisingly strong?
Definitely, Nikunj. If we see the large cap valuation premium over the 10-year historical average was about 10% somewhere in mid-Jan 2018. So probably that little premium over historical average has ensured that large caps haven't corrected as much. And I'll take the liberty of reading from our research which we did yesterday. Of about 829 stocks above 1,000 crore market cap, 136 stocks are down more than 30%. So 16% of stocks are down 30% from their 52-week high. About 225 stocks or 27% are down between 20 and 30%. And 328 stocks, 40% are down between 10 to 20%. So the small and mid cap have taken the brunt of correction. They were about 25 to 33% premium over their historical 10-year average on a price to book basis, compared to large cap which were just about 10%. So there is no surprise that bigger corrections have happened in small and mid cap. Smaller correction or a marginal correction has happened in large cap.
Looking at the setup, which is that there is alternates are doing poorly, which is real estate and gold. There is enough and more money which is coming via the SIP route, and domestic funds have a lot of liquidity. But if you look at the construct of the market, valuations are not attractive and earnings are slightly patchy. So what kind of market do you think we are staring at? Is this like a one-trick pony where markets are not falling because there is liquidity? But if markets only going higher because of liquidity, then the end game is going to be slightly scary.
Nikunj, let's just talk from the positive point of view. Earnings have been patchy, no doubt about it. But if I just take, standard calculation, ignoring one-time gain made by HDFC selling HDFC Life or insurance, Infosys doing write back of taxes, then the year-on-year profit growth for December 17 quarter is almost 30%. Obviously, you have to remove one-time events like gains on one-time selling of shares or tax write back. The profit growth is still 12%. And this profit growth has been achieved in a one lower base effect because of demonetization of December 16, but also the speed breaker caused by high real interest rates and overvalued currency in the current environment. Now, market obviously is hoping that at some point of time rates will become normalized. The inflationary expectations will come down, which will allow rates to normalize. The currency also have started depreciating a little bit, and over a period of time that will normalize. The economic momentum is picking up. The disruptive effects of GST and demonetization is behind us. Going forward, we will see the positive effect of the same. So put all these things together, market is hoping that earnings recovery will happen. This still does not take away some of the concerns which market has on a top-down basis. From a macro point of view, oil prices have moved up from $40 to $60 to 60 plus. Our fiscal deficit has deteriorated, albeit marginally. Current account deficit has widened, courtesy overvalued currency hitting exports and allowing free imports. So overall macro situation looks little bit worrisome compared to 2017. And somewhere in May 2018, we'll start discounting Karnataka election results. December 18, Chhattisgarh, Madhya Pradesh, Rajasthan election results. And then May 2019, scheduled general election. So we are likely to see top-down pressure on market because of the macro deterioration and political uncertainty. But bottom-up market will get supported by improving earnings at the company level.
Nilesh, PSU banks have not been on investors' radar for a long time. But after the PNB scam, there is no reason why one should really buy PSU banks. So both in terms of business and also in terms of market cap orientation, how do you think the PNB scam will change the dynamics for NBFCs and private banks? Will more money move into NBFCs now? Will more money only chase those limited 4-5 private banks and make it impossible for value watchers to buy them? Because you want to bet on financials, but suddenly you cannot bet on 65% of the PSU banks because they are not, you can't trust them.
Nikunj, it is in the PSU banking sector, there are certain large investors. They have bought at every level, a large insurance company, some of the mutual fund. They have been net buyer of PSU banking stock. Clearly, they see value in this setup. From their point of view, all the PSU banks put together have a market cap less than the largest private sector bank, even though they control almost 70% of banking balance sheet. From our point of view, we believe PSU bank has two structural problems which need solution. One, the top management of PSU bank is compensated very, very low compared to market levels. Now, at that level of compensation, how do you attract talent? How do you motivate talent, and how do you retain talent? The second issue is governance standard. Many of these NPAs have occurred not because PSU bankers erred in lending, but they were influenced externally. Unless until we can make this PSU banks board governed and motivate their top management through appropriate compensation policy, till such time PSU bank's structural weakness doesn't go away. It's not that PSU bank employees are not good. Whenever they have been given environment in private sector bank, they have created fantastic institution. In majority of private sector banks, the employees are having origin from PSU banking system. So it's all about how do we give them environment. We will be buyer of PSU bank once we see this kind of environment given to public sector bank employees. Till such time they remain a cyclical play, a trading play. You buy them when they are very, very cheap and sell when they are just cheap.
Morning. You made a very important point about the dynamics domestically that the markets have to deal with across 2018 and then 2019. I mean, what's going to happen globally in any case, I'm guessing we're going to align to that, the fact that it's a heightened inflation world that we are staring at and monetary policy tightening as well. But the dynamics that you hinted towards that, there are a couple of key state elections lined up, and then there's the big one in 2019. If, as the Prime Minister made it extremely vocal on the sidelines of the Economic Times Global Business Summit, that he wants to combine state as well as the big general elections. Unless that happens, do you think the markets are ready in the wake of what happened recently in the Rajasthan state elections? Or could we see a prolonged bout of either a price-wise or a time-wise correction or heightened volatility in the wake of such a big event ahead of us?
See, if we see the last 3 times experience of election and market, in 2004 in expectation of stable government, markets went up, and post-election results when those expectations were not belied and there was a coalition government, even without giving any opportunity for that government to set the economic agenda, markets corrected 20%. In 2009, markets corrected in anticipation of an unstable government. And when election results showed a stable government, markets went up 20% in a single day, even before economic agenda was laid out. 2014 was, in some sense, number of seats expected to be won by BJP in 200. In September 13, expectation was 180 seats. Sensex was 18,000. In May 2014, when the results came out at 283 seats, Sensex was somewhere 28,000. So markets will always try to discount based on election results, based on pollsters, based on Satta Bazaar, or based on maybe astrological factor as well, trying to figure out what will be the shape of the government. If market believes that there is a stable government oriented towards economic reforms, it will continue to go up. If the actual results are in line with expectations, the elevation will be maintained. But if the actual results are not as per expectation, then there will be correction. So markets will find its own way of discounting political certainty or uncertainty, and it will move in accordance with that.
Saying that the opinion hasn't been formed by the market yet. It's yet to price in what the possibility of these elections could be, right?
No, market has priced in at this level of valuation, which is almost 18 times forward earning, that there will be stable government, economic reforms oriented government in 2019. If those expectations receives a jolt, courtesy Karnataka election or Chhattisgarh, Madhya Pradesh, Rajasthan election, then we could see some pressure on the market.
Nilesh, so where is the central bank move in this entire dynamics? And do you think after being status quo for a while now, could we see the RBI actually go tight, and could it actually harden interest rates going forward from here?
So in our opinion, our current inflation is averaging 4.5%. 10-year yield is almost 770. That's a fairly high real interest rate. There are very few countries in the world where nominal interest rates are to this level. RBI has been successful in bringing down inflation from double digit to mid-single digit. Now, what they are probably looking forward is to control inflationary expectation. They have also realized that it is important to anchor inflationary expectation, and which is why we are seeing little bit higher real interest rates than necessary. But a side effect of that anchoring of inflationary expectation is higher cost of borrowing for the corporate India as well as government. Today, a housing loan individual can borrow at 8.35%, and in the recently concluded state development auctions, it went at 8.25%. There is just 10 basis point spread between individual and state government of India. That's too narrow a gap. Either individual consumer is borrowing at a very, very cheap rate, or the state governments are paying very, very expensive rate. The other side effect of high real interest rates is impact on the PSU bank's balance sheet. They have large treasury investments in the wake of demonetization. They bought government securities in open market operations from RBI post demonetization, and they are sitting on huge losses on that. That's impacting their capital adequacy, which is anyway falling short of meeting NPAs. So we are going through a churn where on one side RBI has to manage the treasury losses of the bank, and that's not their job. Second, the spread of government over consumer borrowing, I mean, that's very, very low. Either state governments are borrowing expensive or the consumers are borrowing cheap. Either ways that will have impact. So clearly RBI has to manage inflationary expectations on one side, treasury market on the other side, and also ensure that there is stability in the financial market. They have a tough job.
Nilesh, you mentioned the entire 2019. As of now, from last 2.5 years, this market has not had a macro risk and a political risk. Macros are deteriorating, whether it's trade deficit or the fiscal deficit. So that best of the print is behind us. But a quarter from now, or maybe 2 or 3 quarters from now, all eyes would be on 2019. And my big fear is that if 2019 is about 4 or 5 quarters away, then markets will start getting nervous. The free-flowing spirit of the market could take a backseat.
Nikunj, unfortunately, we are in Trishanku kind of situation. On GST, our run rate is 80,000 crore or 86,000 crore. But the expectation is that it will go to 1,10,000 crore. Why is market having that expectation? Because number of people who are filing GST return has increased tremendously. And there is a general belief in the market, right or wrong, but there is a general belief that if e-way bill is made mandatory, which is likely to be from 1st of April, then the level of compliance in GST will go through, and that should result into 110,000 crore collection every month. If that collection comes, then fiscal deficit problems goes away. So market is in a situation where it is in no man's land. It's in a Trishanku area. Optimists have reasons to believe that things will improve. Pessimists have reasons to believe that things will deteriorate. And hence, I think the market is more likely to be volatile in 2018 as well as beginning of 2019 compared to 2017. If I use a very lighter vein statement, market is in Ajit's parlance somewhere in liquid oxygen state. Oxygen will not allow it to die. Liquid will not allow it to live. The top-down concerns will keep upside of the market checked. The bottom-up support will continue to support the market. So we'll have a range-bound market going up and down. And obviously, if you pick right stocks, you'll still be able to make money, albeit far less compared to what you made in 2017.
Nilesh, so help our viewers breathe in this liquid oxygen scenario. What is it that you do? You know, you've talked about in your notes that IT is one sector which is being aided by the currency moves. But the fact of the matter is IT stocks have already done so well. Is there still opportunity to get in?
So the returns will obviously moderate because IT stock has one move. The second opportunity is visible in agriculture, rural and infrastructure sector. In the run-up to elections in the state as well as center, government will put extra effort on executing things in rural and infrastructure sector. In a layman's parlance, in 12 months they will deliver 15 or 18 months work, and that will create opportunity for agri, rural and infra sector. Some of the companies in agri, rural, infra space have moved up, but there are many still opportunities over there. So we believe if you pick stocks within this sector, and our hypothesis that government will deliver 18 months work in next 12 months comes true, then there is opportunity to make money in this sector.
You also talked about the fact that, you know, there is a bullish bias towards agriculture as well as the rural infra sector. Is that in the light of, you know, as we approach closer to election, there would be higher allocations and perhaps more reforms as well to the rural segment?
Definitely, one, there will be higher allocation from the central budget as well as state budget. Second, the execution speed will be there. In many cases, while the finance minister does provide allocation, the respective ministries sometimes don't utilize all of them, or they get bunched up and utilized in a different manner. The other thing is that there is almost 1,45,000 crore of cess available in various pools: construction labor welfare fund, National Highway Authority fund, afforestation fund, and so on and so forth. My guess is that in the run-up to election, that frozen money, that reserved money in the cess will also be utilized to spend. So over and above the budget, we will see some benefits coming from that cess spending. The third is the public sector undertakings budget. I mean, clearly there will be little bit of urgency in executing projects this year. There will be push for them to execute. So we will see a combined effort from the government side in the budgetary allocation, in the cess pull, and in the public sector undertaking towards spending money on rural, agri, infrastructure. That should create better momentum for this sector.
Okay, Nilesh, such a pleasure speaking with you. Thanks so much for joining in and giving us your take on just about everything that's going to impact the markets, not just now, but in the next 1 to 2 years as well.